Well, hey there, folks, and welcome. My name is Buck Hollister, and I'm a certified public accountant out of Charleston, West Virginia. Now, before we get too far down the road, I do want to be straight with you. I am an AI-generated avatar built to walk you through this material. But the tax information you're about to hear, that part is 100% real. Today, we're going to talk about two of the most popular retirement accounts out there: the Traditional IRA and the Roth IRA. We'll cover how each one works, what makes them different, and most importantly, how to figure out which one fits your situation best. Think of it like choosing between a gas grill and a charcoal smoker. They'll both cook your dinner, but the flavor comes out mighty different. Let's dig in. All right, before we compare the two, let's make sure we're all cooking with the same ingredients. An IRA, that stands for Individual Retirement Account, is a personal savings account with special tax perks designed to help you build a nest egg for retirement. The key word there is individual. Unlike a 401k, which you get through your job, an IRA is something you open on your own, at a brokerage or a bank. Now, IRAs come in two main flavors: traditional and Roth. They both help you save for retirement, but they season the tax bill very differently. Let's look at traditional first. All right, the traditional IRA. This is the old reliable. Here's the deal. When you put money into a traditional IRA, you may be able to deduct that contribution on your tax return this year. So if you contribute, say, $6,000, you might knock $6,000 right off your taxable income. That's a nice little discount from Uncle Sam today. While your money sits in there, it grows tax deferred, meaning you don't pay taxes on the dividends, interest, or gains year after year. But, and this is the big but, when you finally pull that money out in retirement, every dollar you withdraw gets taxed as ordinary income. Kind of like putting a brisket in the smoker. You delay the payoff, but you can't skip it. And one more thing. If you try to pull that money out before age 59 and a half, you're generally looking at a 10% early withdrawal penalty on top of the regular taxes. So it's meant to stay put till retirement. Now the Roth IRA, this is the flip side of the coin. With a Roth, you put in money that you've already paid taxes on. No deduction today, no discount from Uncle Sam right now. But here's where it gets sweet. That money grows completely tax-free, and when you take it out in retirement, assuming you follow the rules, you don't owe a single penny in federal income tax on any of it. Not on your contributions, not on your growth. That's like paying for your ribs at the butcher counter today so you can eat them free at the cookout for the rest of your life. There's also a nice bit of flexibility here. Since you already paid tax on your contributions, you can pull those contributions back out anytime, at any age, with no penalty. Just don't touch the earnings early or you'll run into taxes and penalties. All right, now that we know the basics of both, let's put them side by side. All right, now let's put them on the same cutting board and see how they stack up. Contributions. Traditional gives you the tax deduction today. Roth uses after-tax money. Growth. Both grow without you paying taxes each year, but traditional is tax deferred while Roth is tax-free. Big difference in that word. Withdrawals in retirement. Traditional gets taxed as regular income when you pull it out. Roth comes out completely tax-free if you followed the rules. Required withdrawals. The government makes you start pulling from a traditional IRA at age 73, whether you need the money or not. A Roth? No required withdrawals during your lifetime. And finally, income limits. Anybody with earned income can contribute to a traditional IRA, but the Roth has income caps that we'll look at on the next slide. Speaking of which, let's talk numbers. Now let's talk about how much you can actually put in these things. For 2026, if you're under age 50, you can contribute up to $7,000 total across your IRAs. If you're 50 or older, the IRS gives you what's called a catch-up contribution, and you can put in up to $8,000. That limit is combined, so if you have both a traditional and a Roth, the total between them can't exceed those numbers. Now, the Roth has income limits. If you're single and your modified adjusted gross income creeps up around $150,000, your ability to contribute starts phasing out. Married filing jointly, that phase-out starts around $236,000. Earn too much and Uncle Sam says no Roth for you, at least not directly. The traditional IRA doesn't care how much you make. Anybody with earned income can contribute. But whether you get to deduct that contribution depends on whether you or your spouse is covered by a workplace retirement plan and your income level. Always double check the current year's numbers with your tax professional because these figures get adjusted for inflation. Here's a big one that trips a lot of folks up. Required minimum distributions, or RMDs. With a traditional IRA, once you hit age 73, the IRS says, "All right, partner, time to start pulling that money out." They calculate a minimum amount based on your account balance and your life expectancy, and you have to withdraw at least that much every year. And of course, every dollar you pull out gets taxed as ordinary income. Miss that withdrawal, and the penalty can be steep, historically as high as 50% of what you should have taken, though recent law has softened it a bit. Still, it's nothing you want to mess with. Now here's where the Roth really shines. A Roth IRA has no required minimum distributions during your lifetime. None. That money can just keep sitting there, growing tax-free for as long as you want. That makes the Roth a fantastic tool for legacy planning. You can pass it on to your kids or grandkids, and they get a tax-free inheritance to boot. All right, so which one's right for you? Let's start with when the traditional wins. All right, so when does the traditional IRA come out on top? Number one, if you're in a high tax bracket right now, that upfront deduction is worth a whole lot of money. If you're in the 24 or 32% bracket today, every dollar you contribute saves you 24 or 32 cents on your tax bill. That's real money back in your pocket. Number two, if you expect to be in a lower tax bracket when you retire, the traditional makes even more sense. You dodge taxes at the high rate today and pay them at the low rate later. That's a good trade. Number three, if you just plain need to reduce your taxable income this year, maybe to stay under a certain threshold or qualify for other tax benefits, the traditional deduction can help you get there. And number four, if your income is too high to contribute directly to a Roth, the traditional IRA is still available to you. Now, some folks in that situation use what's called a backdoor Roth conversion, but that's a topic for another day. All right, now let's flip it over and see when the Roth is the winner. Now, here's when the Roth IRA really lights up the grill. Number one, if you're young and just starting out in a lower tax bracket, paying the tax on your contributions today is a bargain. That money then grows tax-free for 30, 40, maybe even 50 years. That's a whole lot of tax-free brisket. Number two, if you expect to be in a higher tax bracket when you retire, the Roth is a clear winner. You lock in today's lower tax rate and dodge tomorrow's higher one. Number three, if you want the peace of mind of knowing your retirement income won't be taxed, the Roth delivers that in spades. You know exactly what you've got, dollar for dollar. Number four, the flexibility is hard to beat. No required minimum distributions, and your contributions can be pulled out anytime, penalty-free if you truly need them. And number five, if leaving something behind for your kids or grandkids matters to you, the Roth is one of the best legacy tools out there. Your heirs inherit a bucket of tax-free money, and that's a mighty fine gift. All right, folks, let's tie it all together. The traditional IRA gives you a tax break today, but you'll pay taxes when you pull the money out in retirement. The Roth IRA works the other way. You pay taxes today, but every dollar you pull out later is yours, free and clear. The single biggest question to ask yourself is this: do you think your tax rate will be higher or lower when you retire compared to today? If you think it'll be lower, lean traditional. If you think it'll be higher, lean Roth. And if you're not sure, well, a lot of smart folks split the difference and contribute to both. Now, everybody's situation is a little different, and the tax code changes more often than the weather in West Virginia. So, when in doubt, sit down with a qualified tax professional who can look at your whole picture. I sure appreciate you spending some time with me today. If you found this helpful, or if there's something you'd like to hear more about, I'd love to hear your feedback. Now, go enjoy your day and maybe fire up that grill this weekend. Take care, y'all.